Recently, at several occasions, we have announced that we were expecting a growth slowdown for the global economy. In the KBC economic scenario, we have a clear declining growth trend. International institutions are now confirming this KBC view. The International Monetary Fund as well as the European Commission have published new growth forecasts. In particular, the European Commission is pointing to a growth slowdown in the euro area. The European Commission is now expecting 1.3% growth in 2019. KBC is expecting 1.1% only. The reason for the growth slowdown is a growth slowdown in particular in Germany and Italy. The German growth slowdown is caused by temporary factors, in particular problems in the automotive industry. The German automotive industry is adapting to new emission norms, and clearly this takes much more time than previously expected. Now, these problems are temporary. On the other hand, in Italy, the problems are much more structural and fundamental. Although the Italian government reached a deal with the European Commission at the end of 2018 regarding the Italian budget and budget deficit for 2019, we expect that more problems will arise in the Italian economy. The lack of reforms and the lack of political willingness to really change things in Italy really will have a negative impact on Italian growth. Now, in other European countries, we see that the economic outlook remains still very strong. For example, in Spain and France, where recently new figures have been published, we see that economic growth is still pretty strong. So clearly there is a heterogeneous picture across Europe. If we compare the European economy to the US economy, we also expect a growth slowdown for the US economy. Although generally speaking, the signals that are predicting this US growth slowdown are not so clear yet. We expect the growth slowdown because on the one hand you have the fiscal stimulus that will fade out in the US economy, and on the other hand the international uncertainties, the trade war and the global economic slowdown of course will have an impact on the US economy too. Sentiment in the economy remains relatively weak, in particular sentiment indicators for the industry. Entrepreneurs in industrial activities are indicating that they expect a further slowdown in the economy compared to recent months. And this is no surprise, given the enormous risks in the global economy related to the trade war, related to Brexit, related also to a harder landing in the Chinese economy. All these risk factors clearly affect the industry. At the same time, we notice that sentiment indicators for services activities remain relatively resilient, which is no surprise, given that services are typically provided in the local domestic economy and are less affected by international events. We are approaching a very crucial period for the Brexit. The British Parliament has indicated that it wants to avoid a no-deal Brexit or hard Brexit, but at the same time it also wants to renegotiate a deal with the European Commission regarding the Northern Irish border. The latter is a very sensitive issue. It remains to be seen whether Theresa May, the British Prime Minister, will be able to reach a deal with the European Commission regarding the Irish border and a solution to the so-called Irish backstop before the deadline of 29th of March 2019. It is possible that the deadline has to be postponed in order to reach a deal regarding this Irish issue. The growth slowdown as well as the sentiment deterioration has major implications on interest rates as well as monetary policy. Generally speaking, we see that the inflation outlook is also deteriorating. The implication is, of course, that central bankers worldwide may not be inclined to increase interest rates fast or further. In particular, for the US economy, we expect that the Federal Reserve will only increase interest rates once in 2019. For the European Central Bank, it remains to be seen what decision will be taken after the summer. We stick to the scenario that we expect one rate hike at the end of 2019 and a gradual interest rate normalization in 2020 in the euro area. Nevertheless, it will all depend on the growth recovery that we still expect at this moment at the end of 2019 and in 2020. Long-term interest rates remain subdued too, and this has to do with safe haven effects. Internationally, investors are preferring low interest rates for American bonds, German bonds, to higher interest rates for bonds from countries that have a higher risk profile. To summarize, we expect economic growth as well as inflation to slow down. Nevertheless, we expect that these effects will disappear and gradually we expect further economic recovery. Hence the economic outlook in the near future is a little bit subdued, but in the longer run we still expect a strong economic performance, in particular in 2020.